Picture two people with the same knee pain in the same waiting room. The first had to call their primary doctor, get a referral, and prove the specialist was in network before anyone would see them. The second just looked up an orthopedist online and walked straight in. Same injury, same city, wildly different experience. The only difference between them is two letters on their insurance card. One has an HMO, the other has a PPO. Here's the catch. That freedom the second person enjoyed. Walking into any office, skipping the referral, even going out of network, isn't free. It costs real money every single month, whether they use it or not. And most people pick the wrong one. They pay extra for flexibility they never touch. Or they save a little and get trapped behind a wall when they need care most. By the end of this video, you'll know exactly which trade-off fits you, using one simple question. So let's break down the 5 things that separate these two plans. Let's start with the single biggest structural difference, because everything else flows from it. Where you're allowed to get care. Think of an HMO as a walled garden. Inside the wall is your network, the doctors, hospitals, and labs your plan has contracts with. Inside, you're covered. But step outside to a doctor who isn't in network, and the HMO generally covers nothing. You pay 100% of the bill yourself. The only built-in exception is a true emergency, which we'll come back to. A PPO works differently. Instead of a hard wall, it has a wide door. It still has a network, and staying inside is cheaper, but it also covers care outside the network. You just pay a bigger share when you go out. Here's an illustrative example of what a bigger share looks like. Say in network, the plan pays 80% and you pay 20%. Go out of network, and the split might shift to the plan paying 60% while you pay 40%. Exact numbers vary by plan, that's just an example, but the pattern is the point. With a PPO, out-of-network care is more expensive, but it's still covered. With an HMO, it usually isn't covered at all. So that's the core trade. One plan locks you inside a garden, the other leaves the door open for a price. Now let's look at how you actually move through each plan when something goes wrong, because this is where the day-to-day difference really shows up. With an HMO, you first choose one primary care physician, a PCP. That doctor becomes your home base and, importantly, your gatekeeper. When something comes up, say that knee pain, you go to your PCP first. If they think you need a specialist, they write you a referral. Only then can you see the orthopedist with your insurance covering it. No referral, no covered specialist visit. A PPO throws that system out. No required primary doctor, no referral needed. Knee hurts. Look up an orthopedist and book directly. You can go straight to almost any specialist whenever you decide you need one. So picture 2 lanes running from knee pain to orthopedist. The HMO lane has a stop in the middle. Visit the PCP, get the referral, then proceed. The PPO lane is a straight shot. This is a genuine trade-off, not just red tape. The HMO's gatekeeper means more steps, but that primary doctor also helps manage your overall care and keep everyone on the same page. The PPO gives you direct access and fewer hoops, but you're the one steering. More coordination versus more control. So that's the freedom a PPO gives you. Now let's talk about what it costs, because it shows up on your paycheck every month. The clearest way to see it is the premium, the amount paid each year just to have the plan, before you ever see a doctor. Let's use the 2025 averages for employer-sponsored coverage from the annual survey by KFF. For a single person, the average PPO premium was $9,818 a year. The average HMO was $9,229. For family coverage, the gap is wider. The average PPO family premium was $28,272 versus $27,277 for an HMO. The overall average across all plan types was $9,325 for a single person and $26,993 for a family. Those gaps might not look enormous, a few $100s for a single person. But here's the framing that matters. The PPO costs more because you're buying flexibility, out-of-network coverage, and direct specialist access you may or may not ever use. The HMO trades that away for a lower price tag. You're not paying more for better medicine. You're paying more for more freedom. And keep in mind, these are 2025 averages. They change every year, and your numbers depend on your employer and where you live. Here's something that surprises a lot of people. Even though we frame this as a 50-50 choice, in the real world it isn't close. Look at how workers with job-based coverage actually enroll. Again, from the 2025 KFF survey. PPOs are the clear king at 46%, nearly half of all covered workers. Next come high-deductible plans paired with a savings option at 33%. The HMO, just 12%. Point-of-service plans take 9%, and old-style conventional coverage is now under 1%. So the pure HMO, the walled garden, has quietly become a minority choice. Most people, given the option, pay up for the flexibility of a PPO or go for a high-deductible plan with a tax-advantaged savings account attached. But there's a catch hiding inside those high-deductible plans, worth one number. In 2025, the average general annual deductible for a single worker was $1,886. What you pay out of pocket before most coverage even kicks in. A lower premium often hides a higher deductible, so a cheaper plan can cost you more the moment you actually get sick. The lesson isn't that everyone should follow the crowd into a PPO. It's that the popular choice reflects how much people value not being walled in, and that the headline premium never tells the whole story. So we've seen the wall, the gatekeeper, the price, and the popularity. Now for the payoff, which one actually fits you, and the safety net that protects you either way. Here's the decision in plain terms. An HMO tends to fit you if you want the lower premium, you have a stable doctor and hospital nearby that you're happy with, and you don't mind picking a primary doctor and getting referrals. If your life is local and predictable, the wall barely affects you, and you pocket the savings. A PPO tends to fit you if you travel a lot, want to see specialists directly without asking permission, or specifically need the option of going out of network. Say to reach a particular expert. If your life is mobile or your care is complicated, that wide door is worth paying for. That's the one question. Do you value lower cost and coordinated care or freedom and flexibility? But before you decide, know this. Both plans share two powerful safety nets. First, your worst-case year is capped. Thanks to the Affordable Care Act, your in-network out-of-pocket spending hits a ceiling. For 2026, that federal limit is $10,600 for an individual and $21,200 for a family. Once you hit it, the plan covers the rest. Second, true emergencies are protected on both. Under the No Surprises Act, in effect since January 2022, emergency care from an out-of-network provider is billed at your in-network rate, and you generally can't be surprise billed for the difference, protecting HMO and PPO members alike. So whichever way you lean, you're not gambling your entire financial future on the choice. And remember, this is educational, not financial or medical advice. Your plan documents are the final word. So let's pull it together. An HMO is a walled garden. Stay in network, pick a primary doctor, get referrals to see specialists, and in exchange, you pay a lower premium. Step outside the wall, and except for emergencies, you're paying the whole bill yourself. A PPO is a wide door. No required primary doctor, no referrals, and out-of-network care is still covered, just at a higher cost share, like that illustrative shift from 80-20 to 60-40. You pay more every month for that flexibility, which is exactly why PPOs dominate at 46% of covered workers, while pure HMOs sit at just 12%. The decision comes down to one honest question. Do you value lower cost and coordinated care, or freedom and flexibility? And whichever you pick, both plans cap your worst-case year. For 2026, $10,600 individual, $21,200 family. And both cover true emergencies at in-network rates. This is educational, not financial or medical advice. If this finally made the letters on your insurance card mean something, hit subscribe. That's the whole point of this channel. The money decisions nobody ever explained to you. And here's the perfect next step. We just mentioned those high-deductible plans a third of workers choose. And the secret weapon that makes them powerful is a special account called an HSA. It might be the single most tax-advantaged account in America. Money goes in tax-free. grows tax-free, and comes out tax-free for medical costs. Watch the video on the HSA Triple Tax Advantage next, and see why some people use it as a stealth retirement account. I'll see you there.